Hi, this is Roger Conrad. I'm co-editor of MLP Profits with Elliott Yu. And what I want to talk about today is just some major developments, I think, and what we've been doing with our strategy in MLP Profits. As readers will note, we've been adding a number of companies of master limited partnerships over the past several months, filling out our portfolio with our favorites. And this is something we'll continue to do. We're getting close to the number that we'd like to have. We're going to probably stick between 15 and 20 individual trusts, and of course quantity is not nearly as important as quality. But I think if you are like us, you're building a portfolio of these things, this is an ideal time to do it. Right now we're seeing we've seen some pretty large gains from a number of our picks, particularly off the bottoms of earlier this year. And that's been gradually unfolding over time as investors who panicked and dumped everything in the latter half of 2008 in the wake of the credit crunch have been starting to come back to things that they deem to be relatively conservative. And so, of course, we've seen some retracement. We're still, though, well below the levels that we saw over a year ago. And, of course, a year ago is when Lehman Brothers went down, and a recession bear market that had been relatively mild at that point, particularly to stronger fare that had begun in the middle part of 2007, really worsened, and things got considerably more hairy, and even some of the strongest stuff out there really crashed and burned. So we've come off those lows, but we've got a lot further to go. I think if you want to look for extremely positive mega developments for the MLPs, certainly the energy market remains somewhat weak. But there are sections of it, particularly those based on fees like gas storage, that are doing very well. And the companies that have been savvy enough to move into those assets do very well, one of which is Enterprise Products Partners, which has been doing extremely well by capitalizing off the spread between relatively high oil prices and relatively low, very low natural gas prices. So that's a major positive development, and markets have somewhat stabilized in that sense. Again, these are companies involved in the energy industry, but are not directly impacted by energy prices, and therefore have continued to do very well. Another thing, though, that's probably even a bigger mega trend that's helping these things involves credit. Now, certainly the credit markets remain very tough for a large number of people out there, particularly individuals, particularly companies that have held to a large amount of debt. Anybody that's not measured up on the credit spectrum is having trouble getting credit. On the other hand, corporations and even those rated BBB are higher, and BBB being a moderate investment grade on the lower end of the investment grade scale. But these companies are like individuals that are high net worth or that have relatively low debt, are now very much preferred customers, and companies have become very aggressive, those who in lending money, and that's also translated into prices in the bond market. And of course, if you look at the spreads between the 10-year Treasury bond, which is basically the low risk or no risk interest rate, at least no credit risk interest rate, and what LPs have been forced to pay, master limited partnerships, or even any BBB rated corporation has been forced to pay over the past year. The spreads have been fairly horrendous. I mean, we had spreads as low as 150, 200 basis points. In other words, a BBB bond would have to pay 1.5% or 2% more than U.S. Treasuries to market a couple of years ago, and those spreads went to as high as 700, 800, and in fact, a number of companies couldn't even borrow for a time there in the latter half of 2008, and even into the early part of 2009. Well, what's changed now is those spreads have come down dramatically once again. So now, instead of 700, 800 basis points and higher, now those spreads have come down to 200, 250. And that's a tremendous plus for these LPs. LPs basically grow their dividends and their cash flow by adding assets. The only way they can add assets is either by issuing shares or by borrowing. And the cost of either of these forms of capital has a tremendous impact on what projects are profitable, how profitable various projects are, whether projects should be started, whether an acquisition can be made. The fact that spreads went so wide 6 or 8 months ago really restricted business activity. A number of companies like Enterprise kept pushing through, which was, again, a very strong testament to their underlying strength. But now those spreads have come down, so companies like Enterprise have a tremendous ability, again, to expand their capital bases, to expand their asset bases, expand their cash flows, and then by extension, build dividends, increase dividends as they've done for, I guess, 23 consecutive quarters now. Build those dividends more, and that, of course, translates into higher share prices. So this is a tremendously bullish trend. And again, if you're getting into these MLPs now and getting into those that we have in our portfolios, I think this is an ideal time. I think you're going to be very, very happy with the kind of returns you're going to get going forward. So take a look at the product and take a look at the MLPs we like. Maybe buy a third put a third of your investment down now, a third a month from now, a third a couple more months from now. These are going to be things that you're going to want to buy and hold for a very long period of time. And that, I haven't even scratched the surface even on the taxation issue. Most of them, you won't owe taxes on the dividends until you wind up selling. So again, very, very positive trends for an asset class that has been through the fires. You know, there were a lot of new issues that came out in the early part of 2007. A lot of those failed. But the ones that are left are battle tested, and again, they're paying a lot of, they're not at their lows, but they're still much closer to those lows than they are to the highs that they had just a couple of years ago. Dividends are high, dividend growth potential is very high, again, because the credit markets have improved, and that's a very, very bullish prescription going forward. So that's all I have to say today. Look forward to chatting with you again in the future.